Hi there and welcome to Money Managers, a User's Guide. I'm Nathan Peters. We're going to take a slight detour into macro land today, but fear not, we will always come back to our beloved active money managers. Allow me to set the scene. So the US caught a blue wave, and yesterday President-elect Biden announced his American Rescue Plan, which means, among other things, a potential doubling in the minimum wage to $15 per hour. Pundits and markets are taking notice, with long dormant measures of inflation rising ever so slightly alongside bond yields. Is this the final chapter of the new normal, with the rising cost of money deflating the price of assets with duration, whilst long neglected real assets, which are meant for production and current consumption, finally get their day in the sun? If so, this will have massive implications for every investor who has enjoyed a wonderfully good risk-adjusted returns with a standard portfolio of bonds and equities, the two reigning champions of the past decades. If we bring up our factor performance history screen in Venn, we can see that no other asset has a better return than equities, about 5%. And no other liquid asset has a better Sharpe ratio over 25 plus years than bonds, about 1 times. And they have been negative 0.2 correlated over that entire period. So you had the best of all worlds, so much so that low-cost passive funds indexed to these assets have grown to comprise over half of the mutual fund and ETF market for them in the US, from a sliver at the start. However, at the end of the day, market prices can only incorporate what is known and what is expected. By definition, unexpected changes in the macro landscape are not reflected in market prices, as we saw last February, March with COVID. And once that new environment is recognized, the market wastes no time reflecting it, which is why some of the great and the good, such as Nassim Taleb, author of The Black Swan and other books, advocates collecting cheap options for multiple eventualities. It's here, at the coalface of markets, that prices move the fastest and with the most convexity. And that brings me to the subject of today's video, the IVOL ETF, which is actively managed by Nancy Davis at Quadratic Capital. It is not active management in the sense that Ms. Davis is explicitly forecasting variant views to those priced in markets. It is active in that it can take OTC derivative positions that Ms. Davis feels represent an acceptable cost to insure against future uncertainty. And if we take a step back and think about what markets may not be anticipating, thereby offering the greatest bang for your buck, top of my list would be instruments tied to the inflation dog that hasn't barked, but it is whimpering. I encourage you to head over to the website, where the manager is very transparent with the portfolio and how it works. But let's see how the fund is performed, shall we? First off, Venn shows us that IVOL has outperformed its largest holdings, the Schwab US TIPS ETF, with lower drawdowns and higher vol. And relative to that benchmark, it takes about 8% tracking error. If we just move to relative, here we go. 8% tracking error for an information ratio of about 0.3, which isn't bad at all. If we check the factor exposures relative to the TIPS ETF, we see that she's hedging out the interest rate risk embedded in TIPS, which, as regular viewers know, it's not a risk that's rewarded really at all in my view. And if we look just on an absolute basis, IVOL has a greater sensitivity to inflation markets than TIPS, as designed, and is negative carry, which reflects the costs of the options. If we go to the factor contributions to risk, there's no doubt that this is an actively managed strategy, with fully 40% of the risk of the fund dependent on Ms. Davis's decision-making. And as you can see, if we go down to the factor contributions to return, investors have benefited from her decisions, making 4% per annum on average, or just over. So when you paid the 1% management fee to own IVOL, you gave Ms. Davis 1% out of the 5% gross returns, or 20% of the excess returns. Pretty good finder's fee, in my opinion. And of course, the market has rewarded this. IVOL has attracted assets of over $1 billion since launching in May 2019. For me, this is how it should work. Smart, motivated individual sees a market need, exploits anomalies they are well trained to identify and underwrite. Said individual openly and transparently executes on their strategy, and the market rewards the effort. Of course, the transparency could lead to future competition, but actively managed ETFs are a nascent marketplace, and so far, IVOL is the only ETF of its kind. So kudos to Ms. Davis. Long may the excess returns continue. And to you, the viewer, If you want to try to retain purchasing power as we clear the final hurdles towards our collective future of debasement, I think considering IVOL alongside other commodities and real assets is a reasonable place to start. That's it for me today. Thanks for making it this far. Don't forget to like, comment, subscribe, as it really helps me understand if I'm doing a decent job as communicating with you guys. And remember, use your money managers. Don't let them use you. Peace.